I'll call the pension committee meeting this morning. Madam Council, would you read the roll?
Yes. Director Pacho,
Here.
Director Sholas, Director Markowitz, Mr. Heller,
Here.
Mr. Davis,
Here.
Mr. Johnsey, Ms. Johnsey,
Here.
and Mr. Big Bull. Chair, we do have a quorum, and now we're ready for the presentation.
We do have, okay.
We do have a quorum, and we're ready for our first presentation, which
Okay,
is,
first presentation item is the executive summary of the May 2023 market performance report. Quaco, and welcome again.
Thank you. Okay, so good morning, everyone. And I'll be relatively brief with my comments. All in all, the news around the portfolio is positive. So that's one thing I do want to mention. Year to date, we're in good territory. The numbers should be, if this month kind of ends how it's continuing, we should be looking at a pretty strong June, a pretty strong second quarter period. So all in all, the news around the portfolio is good. That's the key takeaway. We still have quite a few moving pieces with respect to the asset allocation. So there is a resolution, on the agenda, which will help, redistribute some of the portfolio into approved asset classes that we currently do not have exposure to. But again, the takeaway here is portfolios in good standing. The asset allocation, we continue to transition to the approved asset allocation. Those are the two key takeaways. Everything else I'm going to go through, and happy to take any questions as I go through talking points.
Fine.
So as we think about the month that was the month of May, the debt ceiling discussion, thankfully that's in our rearview mirror for the next couple of months. But the debt ceiling, really the discussion or the game of chicken around that caused a lot of volatility within the market. Another source of volatility, CPI or inflation, add those two things together, led to a lot of volatility and a lot of sell-off within the market for the month of May. The debt ceiling discussion, just as a quick recap, this was a standoff at Congress, this strange discussion about whether we should pay the bills that we've already incurred as a country. That obviously has very negative ramifications for debt, the debt markets, and treasuries generally. Any type of default, given the fact that the dollar is the currency of last reserve across the global system, that really speaks to the volatility that we saw during the month of May. And then with the CPI, the Consumer Price Index, this is a measure of inflation. This measure of inflation is what the Fed has been looking at, in tandem with its interest rate hikes. CPI had increased tremendously as a result of spending and supply chain disruptions, energy going up. Therefore, the Fed has raised interest rates 10 times consecutively to get us to a point where interest rates can cool off spending and the money supply essentially. With interest rates, the expectation here is for potential rate cuts later this year. The honest answer is we don't know if the Fed is going to cut rates or raise rates. Right now, all eyes are on the Fed for later on today, this afternoon. The expectation is they're going to come in with a pause on the rate hikes. The Fed funds rate is between 5 and 5.25. That's significantly higher than where we were even a year ago. So that 5.25, there is a risk that the Fed may have overshot the interest rate hikes, meaning that it may have been too aggressive in terms of raising interest rates. So the slowdown in the economy may actually be deeper than anticipated by the Fed. The flip side of that is maybe the Fed hasn't raised rates aggressively enough, and if that's the case, there's more pain ahead. And this uncertainty is what leads to volatility within the marketplace. The market likes certainty. Whenever there's a strong trend, the market will pounce on that and squeeze every dollar of profit it can from that. When there's uncertainty, any little bit of news, the market's willing to sell off or buy up based off that. So those are the key themes there. As we think about the various asset classes and the impact of the debt ceiling discussion on those asset classes, fixed income definitely had a challenging month, so down 1.1% for the month of May. And again, the discussion around the debt ceiling was a key contributor to that negative return. The yield curve, I mentioned this the last time I was here, but we'll mention this again. The yield curve is also pointing to an economic slowdown. The inversion that we see on the blue line, the May 23 line, does point to shorter term rates being meaningfully higher than longer term rates. That basically means that right now, prospects are viewed more favorably than they are going further down. Therefore, an inverted yield curve, again, is predicting an economic slowdown. We're seeing a lot of mixed signals in the economy where CPI is up, so inflation is up, but a slowdown is projected. The Fed is looking to potentially pause on interest rates, but they could still raise rates. CPI came in at 4%, so still higher than the 2% target for the Fed, but still lower than what projections were. So again, a lot of signals pointing to many different directions. And again, that theme of uncertainty and volatility around uncertainty continues to capture the market. On the U.S. equity side of things, the month of May was also pretty volatile. Now, certain segments of the U.S. market held up pretty well. The S&P 500 is a good example of that. But then when you decompose the performance of the S&P 500, it was literally a handful of stocks that lifted up this index, and those stocks were in the technology sector. The interesting, confusing, muddling thing that's happening right now, if you look at the various indices, are the delta or the differences between core value and growth. So as I mentioned earlier, the core index is up in positive territory. However, the value index is in negative territory. The growth index is in positive territory. So we can use the Russell 1000 as examples. Now, the really interesting thing here is the reversal of performance between value and growth. In this environment where I've just mentioned uncertainty, we don't know what the Fed is going to do around interest rates, there's the debt ceiling discussion, you would expect value stocks to be outperforming. You would expect value stocks, these are your Johnson & Johnsons, these are your older companies with established product lines, good cash flows, paying dividends. You would expect those stocks to be doing well in this environment. But what we've actually seen is, again, the tech stocks really just run off and do phenomenally well. Part of that has been the correlation effect with stocks like NVIDIA. NVIDIA has a partnership with, the name escapes me, but one of the leading AI firms right now, and that's led to a significant run for NVIDIA. The technology sector doing very well. Again, it's more of a head scratch at this point because you would expect value to be doing very well, just given all the points I mentioned around the economy, where the economy is, uncertainty, and so on.
But is value not doing well because of labor? I mean, you could have both sectors be positive. They're not inversely related.
So typically with value, when the economy is in delicate territory, value stocks, those stocks with good fundamentals, strong cash flows, are typically the stocks that the market would reward. But what we're seeing here in this environment is, value's hurting for a couple of reasons. So firstly, the market participants aren't as concerned, it seems, around valuations and fundamentals. So I'll take NVIDIA once again as an example. That share price is at like 3,000 times gone through the roof. That's an example of investors just paying for something versus seeing the true potential value of what's within the stock. With the labor market, it's less so about the labor market because the Fed will argue that wage inflation is sticky and it's problematic, but it's been from supply chain, right? It's been through the supply chain, oil, and so on that's really led to the inflation we're seeing. I think wages have been well overdue a bump up, and this is just my belief, I think a lot of the talk around wages is to really justify the interest rate hikes, right? Because it does impact your mom and pop and individuals more than companies. Companies can borrow at much cheaper rates than individuals and so on. So I feel that part of that discussion is to kind of like retrofit the reason why interest rates are going up so significantly. The other reason why value stocks have taken a hit is around the financial sector. So financials do represent a component of the value index. As we know, Silicon Valley Bank, Signature Bank, Credit Suisse, First Republic, in the month of March, they all went through their own versions of what a challenging environment is. And the drag on financials was also a relative drag on value. So, those are some of the factors that have led to the dispersion. But that being said, we would expect in this environment, staples, consumer staples, things that you can do without versus consumer discretionary, things that are nice to have. You'd expect staples to be outperforming discretionary at this point, just given the fact that discretionary spending with rates going up is, should be on the lower end, right? And staples, the essential things you need, should be rallying more in the marketplace. So it goes back to the theme of
Well, we didn't see that in the past 2 years.
No,
Discretionary spending didn't diminish.
Yes, because we had stimulus spending. So literally we had stimulus spending and that's why. But as things are slowing down with the economy and there isn't the stimulus and there are rates going up, we would expect a rotation away from discretionary spending to more stimulus-like, to more staple-like consumption, which isn't happening presently.
And with the financial industry, though, is there a difference between the FDIC-backed assets versus non with the bailouts? Like, is that what's pulling this?
So financials, it's really just the correlation. So it's the regional banks are essentially just pulling down the financial sector, generally speaking. Just more pressure on that sector because of the subsector of financials. So it's the regional banks that have had that negative impact. On the non-US equity front, we've also seen some positive returns coming in, but it was a pretty rocky month of May, and it does underscore the importance of the US.
Excuse me.
Yes.
May was just a snapshot because of the debt ceiling argument. Other than that, everything was pretty much following the same trend.
Yeah, I mean, I would say year to date, the trend year to date continues to be a positive one. But even though the trend is positive, the journey is still a volatile one. That's the way to look at it. So, the international markets also capture that same trend where it's still trending towards positive returns, but there have been up days and down days based off, news events.
Yeah.
Yep. Real estate here, the reminder is, this is a good diversifier to other segments of the market, but real estate is one of the areas that had an exceptional 2022. So, this has been poised for write-downs or mean reversion from a return standpoint. For an investor like us, this is probably a really good time to be going into real estate because over the long term, this is one of the asset classes where we're expecting, nice single-digit returns. So buying at a discount, again, is, in our opinion, a good entry point. Same can be said for infrastructure, really good diversifier against the equities and fixed income. We're looking at 4Q numbers because this is just a lagged asset class. So the lagged valuations are one of the benefits of the asset class. And same can also be said for private equity as well. So with that, we'll jump into the portfolio. Through the end of May, we were looking at a return of 4.5%. We were a little bit behind the benchmark, but again, the expectation here is for that delta to have closed, that gap to have closed up. You will see that some of the managers we have exposure to that are good managers, and examples, Earnest Partners. This is a core strategy, but more quality or value leaning in terms of the stocks. Those are the types of strategies that through the end of May were lagging, but through year-to-date June, we've seen a huge resurgence in value. So value has continued to kind of bounce back really strongly. And the key thing, I guess the key question will be when we're here looking at June returns It's a question of, is the market rotating because there's something that the market's finally seen, and we're going away from more discretionary type to more staple type expenditure? Or is it literally a few investors chasing a few stocks and then bidding up the price of the stocks, and it has nothing to do with what the market's seeing? So more to come next month on that. But again, we're up pretty meaningfully over that year-to-date period. Over longer terms, we continue to see a pretty nice delta relative to the index. And all in all, portfolio returns continue to be a good story for us. Looking at the various composites really quickly, the fixed income composite, equity composite, for the month, we did see relatively strong performance, protecting on the downside. And then other areas of the portfolio, I mentioned real estate being one of the areas of the market that's going through some degree of mean reversion. So REITs were a relative detractor for the 1 month period. But again, as we move further out to the year-to-date column, year-to-date comfortably in the positive, and that delta or the difference between us and the benchmark at 40 basis points, we do expect that gap to narrow, again, based off what we're seeing month to date in June.
Can you explain 40 basis points? What does that
Yeah, absolutely. So the basis points are basically the percentage points. So 4.5% is our return, and then 4.9% is the return for the index. So 40 basis points is the difference between them. So it's 0.4 of it's 0.4 of a percent difference, basically. So it's just called basis points in industry terms. And the difference is, again, it's between the 4.5 and the 4.9, the difference of 40 between 4.5 and 4.9 basis points, that explains the performance differential.
So we were anticipating 4.9 and we got 4.5 based on actual.
You can look at it that way, yes. So the index, had we just been invested in the index, we would have gotten 4.9%. But active managers can outperform or underperform during this period, where the active managers did see some underperformance. That does account for the 40 basis points. So that is a correct assessment. If we were just passively invested, it would be 4.9. Now, the reason why we're not passively invested 100% is because if we go further out, you will see the green relative to the index, meaning that active management can underperform, it can outperform. And net, if we have conviction in active managers outperforming in certain segments, we will have active managers in with the understanding that they perhaps won't outperform over every measurement period, but over the long term, we're expecting them to add value over the index.
Does that basis point include the cost of active management? Because I see 10 years, you only have 30 basis points difference.
Yeah, so it's net of fees. So it does take into account all of the fees paid. And I will say this, the change in asset allocation does capture ways in which we can be more efficient with the budget that we have for the managers we pay. So in certain sectors of the portfolio where we've had active managers, let's say large cap, that's an area where we're going to remain passive, keep the fees lower. And then other areas of the portfolio where we think active management can really add value in excess of whatever fees are paid, that would be private equity, infrastructure, and so on. So net, we're also being very thoughtful around net of fees, what the return stream could look like based off the asset allocation that was recently approved.
And the basis points translate to what monetarily?
Oh, monetarily?
Basis point is just 1/100th of a percentage.
Of our total value?
That's the definition of a basis, just
Of anything.
1/100th.
Okay.
Appreciate it, thank you. So from a performance standpoint, again, we see top performers, bottom performers. To my point earlier, you take a look at Earnest Partners, they return 4.5%, the index 4.8%. Earnest Partners over the long term has been a positive contributor to returns. This period of underperformance at 30 basis points doesn't really, it's a rounding error in our opinion. We still feel that Earnest Partners over the long term is in a position to outperform the index. The reason for that underperformance does make a lot of sense. The talking points we just had around quality and value not being rewarded by the market. This is a manager that will lean more towards quality and value. That's the type of strategy you want, particularly if you go through significant down periods. So again, while they are listed as a bottom performer over the year-to-date period, we continue to think Earnest Partners is a good manager to maintain in the portfolio. The asset allocation versus target, we do see here, again, just a quick reminder on the changes that we are still working towards within the asset allocation. We have a 10% approved allocation to private equity. We also have overweights in areas of the portfolio, and those overweights will naturally correct themselves as we select managers to fund in new pockets of the portfolio. This is just a timeline. It just points to actions taken since the third quarter of 2021. And then the asset allocation, once again, we show what the old allocation was, what the new allocation is, and ultimately we're continuing to work towards the new asset allocation. As we think about the new asset allocation, I'll give a quick update on the RFPs that were issued a couple of months ago. RFPs were issued for infrastructure, real estate, and private equity. We got a good number of responses across all three asset classes. So definitely on the private equity front, I want to say over 20 responses, infrastructure approximately 20, real estate between 15 and 20 responses. So all in all, some really good responses. And the goal is to work through all those responses with my colleagues in research and then put together a recommendation list for your review. We'll walk through expected performance for the managers as well as past performance. We'll talk about ownership. We'll talk about location, geography, anything that is pertinent to you as a committee. But just wanted to give a quick reminder that the RFPs were submitted. Our research team is going through those presently, and the goal here is to have these additions to the portfolio later on in the year.
When are you supposed to select those companies?
So the companies, and I will have to also defer to Gray on this as well, as this is the first time we're going through these searches. We are going to compile information on candidates that we would recommend pursuing further, typically around 4 candidates from all the responses. As this is the first time, I'm not sure if your preference or legal needs us to...
The recommendations have to come before the pension committee and then eventually to the board of trustees. And those recommendations will be made by Quaco, and then we will decide at that point. But the recommendations must come before the pension committee and the board of trustees, and we will vote on those. And you all will vote on those.
And you're going to lay out the threshold of the selection, like what criteria you're looking at,
Absolutely.
historical performances.
Absolutely. So each asset class will have what we call a search book accompanying it. So we'll go through a lot of information on each particular strategy. We'll actually compare the strategies against each other as well as their benchmarks. We'll take a look at fees, sector allocation, team, stability of the team, up-down capture ratio. So a lot of analytics to help inform the decision. So, more to come on that. I will coordinate with Gray.
Do you have any date in mind?
We were thinking August, as it typically takes another 6 weeks or so from the submission of the RFPs, but we were looking around August for those deliverables to make it to you. And then it's really, again, you're in charge of the process, so it could go one of two ways. We make the presentations, you guys just say, okay, this is excellent, we'll go ahead, we'll move full steam. In some instances, committees may want to meet with the managers, or they may have additional questions. So depending on how the initial discussion of data goes, we can determine, what the best course is around.
So it may be
hiring.
advisable to actually give your recommendations to the committee in August, and then we perhaps can vote on those in September, so that the committee will have an opportunity to actually review the documents and the recommendation that you have, and that would give the committee and the Board of Trustees enough time to answer or ask any questions or have any questions presented for the September September committee meeting.
So,
We do
Could be
have,
narrowed down to less than 5, right?
Yeah,
Okay.
absolutely.
I'm sorry, Mr. Fisher.
we do have the option to have managers come in and present.
Yes, yes.
so the goal would be to assign a company for each one of these asset classes for management, or is it to
Yeah.
assign individual managers to each one of these asset classes? And are we
Oh.
looking for 3 individuals, or
Companies.
infrastructure, real estate, and private equity, like 3 companies?
Yes, that's exactly it. So 3 separate companies. So you could have, 3 separate companies
Okay.
for each asset class. So it would have to be a very special company that would do all 3 that we'd be comfortable with. So it's going to be separate tranches and separate managers, separate criteria, and separate documents. So we can kind of just make individual decisions and then move on based on that.
Okay.
So here, these are just quick snapshots of the changes that have been made within the portfolio. Again, as we think about rebalancing, the addition of index funds, all of this has helped us move closer to the approved asset allocation targets. And then as we look at current and future search activity, we just described the searches that are taking place for private equity, global infrastructure, and private real estate. The other areas, once we've concluded with private equity, global infrastructure, and real estate, would be on the traditional side, where we would be looking at potentially active managers in these segments listed. So another round of RFPs to come, but less time sensitive because we have passive exposure within those segments of the market. All right, so that concludes the May overview, and happy to take any questions. Again, the key takeaway here is performance has been good. No actions recommended on the managers, given the fact that we are still in transition within the portfolio. And again, June returns, should they continue down the same path, we'll see when the Fed has a knack of making announcements, and then the market sells off whenever the Fed makes an announcement. But if they can kind of not do that today, this could be a stellar month for the portfolio and for the markets. So
Can you summarize in your presentation next time around that which asset class has outperformed the comparison in a table?
oh yeah, we usually have a periodic table, so we can definitely add that in. So we can definitely do that in the next
Thank you.
presentation.
Thank
Yeah,
you.
absolutely.
And as far as selection, are these companies on a fixed administrative cost or a percentage of the gain or loss?
So it's going to be on a percentage of assets, and the cost will vary depending on the asset class. So private equity, for example, is going to be more expensive than your infrastructure or your real estate, but all of them are going to be a percentage of assets.
Just not any surgical answer. What is our administrative cost in managing these portfolios?
I actually have that in the book. So we have, and when you say administrative costs, you'll talk out the manager costs, right?
Yes, sir. Managing costs.
Yeah, so I have it right here. So we are paying what we call, I'm gonna say 34 basis points, but in dollar amounts, it's $746,488 being paid to managers presently.
For all the asset classes?
For all the asset
Not
classes
bad.
presently.
Not bad.
So that's not bad, but we do have a lot of passive right now. So the cost will maybe it will definitely go up once these searches are concluded. So right now it's pretty low, but those numbers will go up a little bit.
Thank you, sir.
What percentage of passes do you want to settle in on, after the complete asset allocation?
So passive, We're of the belief that in the traditional segments of the market, so when we think about US equities, even fixed income to some degree, having a little passive exposure will make a lot of sense, just for rebalancing and tracking error purposes. So I would say on the traditional side, we'll definitely have, in certain instances like large cap, 100% in passive. Other instances like small cap, just a sliver in passive. So ballpark, I would say at least 40-ish% of the portfolio, or the traditional part of the portfolio, would be passive.
Okay, now another question I have, what's the total value of the total composite fund right now? Do you know that yet?
Right,
I never saw that on any,
yes, right. I have it through the end of May. Now the number will be a little higher,
I know it's gonna roll.
but about 220 million.
Okay. They used to give us that on, a little one-page sheet with all the different assets, what they did for the month, just like you guys did, but we had like a little, we'll call it a cheat sheet, a little one-page sheet, and we
Yep.
always could kind of watch the fund.
Absolutely. So yeah, we do have, and we can add this to the executive summary.
Okay.
But we do have, just for those of you that need some nighttime reading, there is a more extensive performance report that will give a more granular breakdown of the portfolio, the managers, account balances, and things like that. But for the purposes of the executive summary, we can add a couple of exhibits. So one would be the periodic table, and then the other one would be just the addition of asset values. We can definitely do that.
That's just something all the retirees, whenever they see me, how much we got in the fund right now?
Absolutely.
You know,
Absolutely.
I like to give them, I know it's up and down, but I get that every time I talk to someone around. If I
Absolutely.
see them in a grocery, what's the value of the fund right now? They don't want to hear all these numbers. They can look at that. Well, last year it was at this. They know.
Well, you know, one thing I can do, if it's helpful for you, and I do this with some of my municipal clients, either the day of the meeting or the week of the meeting, I can get you like the previous Friday's closing values.
So once a month.
Yeah, and then that way it will give you
That
a
would be
sense
good.
of, okay, did the portfolio go up or down since we last met? So we can
good,
definitely do
yeah.
that.
It's just a real easy way to look at it. Like,
Absolutely.
you said this basis point, last year we had this much.
So we can do that.
It's
And in
just a
fact,
layman's term. Thank you.
I'll actually just jump here really quickly. And this is my terrible eyesight, so I can not really see these pages. But in case you ever need
I see
it
it.
outside of the executive summary,
Mhm.
we do have all those numbers there. So you'll get to see
Okay.
over the last couple of years how much has increased from investments, and then how much the cash outflow has been. And then you get a sense of how much is in each segment of the portfolio.
Yeah.
With that being said, we can definitely add something
Just a little
to
breakdown,
the
right.
executive summary. Yeah, we can definitely do that. But hopefully that's helpful.
Oh, yeah, I'm out of here.
And then those are the fees, once again, in terms of the administrative fees. So
Right.
But the current fee, what's the percentage passive right now that is tied to that current fees? You said you're trying to get to around 46% passive. What are we now?
so it's around 40% passive. I would say right now we would be, let's see, so large cap is 100% passive, mid cap is 100% passive, small cap is 100% passive, and then everything else is active. So
Email, right?
back of the envelope, our passive exposure, if you just bear with me for another 10 seconds or so.
Investment charge, that's just last month,
Mhm.
year to date.
Right, so it is, it's about 35% passive exposure right now, about 35%. So that's the large cap, mid cap, and small cap exposure.
6%.
Yeah, but
About
overall,
40-ish
it's not
percent,
that
40-ish,
about 40-ish. But
This is-
temporarily, we are gonna add passive exposure on the international side as well.
it's not
So
that
that's
bad.
gonna be on the non-US small cap as well as the emerging market side. So that's actually gonna increase how much we have. So again, 40-ish percent is pretty reasonable when all is said and done.
Thank you.
Okay, any further questions or quick on that? Okay, thank you. And the asset allocation transition plan?
Absolutely. So Were you gonna take this, Gray, or you
But
gonna
you,
do?
you talked about this one already, right?
Yeah. But I can pull it up in case there's questions on the movement and everything. But very quickly, just, in a moment, Gray will be going through a resolution. That resolution will be talking about rebalancing. And the legacy points to, where we're moving from, and the approved points to where we're moving to. And the recommendations being made today are just gonna assist us going from the legacy to the approved. So just keep that up for reference.
Okay.
And what's the schedule, anticipated schedule to complete some of these changes? I realize it has to do with the active management that's going on right now.
Yeah. So I would say by the end of the year, we'll definitely, we should have, by the end of the year, the manager selected in the infrastructure, private equity, and real estate segments.
Okay.
We will have the passive exposure, so by the end of the year, we'll have the exposures we need from an asset class standpoint in the portfolio. The active searches for some of the other asset classes, like small cap and so on, they could spill over to the new year, or we might be able to conclude them by the end of the year. But again, from an asset class standpoint, by the end of the year, we should be, exposed to everything that we want to be exposed to.
Okay.
So by contractual obligation, there is no certain time we have to transition to the new manager.
No. So the nice thing here is, and we've said this on the record a few times, any new asset allocation, it will typically take a couple of quarters to transition from the old allocation to the new allocation. And this is moving at a pace that, makes sense given our procurement process and the fact that, deliberation needs to happen, analysis needs to happen, and so on. So moving at a good pace.
And so just FYI, for the committee purposes, we have to go to the Board of Trustees first to be approved, and then Quaco can then move forward.
Okay.
Okay. Then we can move to Resolution R-81, 2023, authorization for Marquette Associates to reallocate non-equity funds.
Yeah,
Ray?
the resolution as presented rebalances the investment portfolio, moves approximately 7 million each from our international equity manager to 2 additional BNY Mellon funds, which specialize in small cap and emerging markets, all within the international equity asset class. These recommendations are consistent with the target asset allocation, as we heard from Marquette, and we appreciate the committee's vote to advance the resolution forward to the Board of Trustees.
Okay. May I have a motion then to approve?
Aye.
Question? May I have a motion?
Yes, sir.
So moved. You just-
So
just-
moved,
just
yeah.
say so
Second?
moved.
Second.
We have a motion and a second. Any discussion? Any public comment?
No public comment,
Okay.
Chair.
All in favor?
Aye.
Opposed? Motion carries. Thank you. Next item, you have information items listed. You have the supplemental performance report from Marquette. And I just want to make a comment about the second informational item, if you bear with me. This has come up from a member inquiry and response, and even though we're not looking to have a lengthy discussion, I just wanted to read to you again what was done. All committee members have been provided a copy of the original request and a detailed response letter and a letter from our actuary who assisted to provide estimated dollar impacts to assist in the discussion with the committee members. The cost of increasing the rate of service accruals is cost prohibitive given our funding policy. Thus, we do not feel the need to have further discussion, but to provide all the information for the benefit of the committee members. Also, management does plan to undergo a 5-year experience study and plan design review in the future in accordance with the pension plan standards. That's currently where we are. I just wanted to make that statement. If we have any
Get that
questions.
documentation? I haven't seen any of this. This is the first I'm seeing it.
It's in the information items. It should be in your information items. It's not?
No.
Okay, we'll make sure.
Yeah, and
Greg
all of the documents should be included in the information.
It was sent out in the
items.
packet.
was done in the packet.
So the current status is that it was requested and it's being reviewed by the actuarial manager on
No, the
impact?
request was made by a pension committee member, Mark Hatt. Our actuary actually responded to that, and so that should be in your packet, the inquiry as well as the response. And that's just for the information items for all of you all. We wanted all the pension committee members to read it, so it's in the packet. And just FYI, like Mr. Pacio, the chair said, in fiscal year 2024, we are doing an experience study, which will address the same matters that were brought up in the inquiry by the pension committee member.
Okay, so the overall response is not feasible from a cost benefit perspective for any of the 3 items.
Correct. And just also know that this is going to be brought up again in our experience study. A couple of, I think last year, maybe 2 years ago, the board of trustees voted on in a resolution that was passed that the board should do a experience study every 5 years.
Can you explain what that entails, an experience study?
I'll agree.
Actuary under pension standards, every 5 years, looks at assumptions and actual rates of termination and salary rates. All the key assumptions have to be reviewed every 5 years. And as part of that, the plan design is typically looked at, and changes considered, or features to see how they're working. So that's what an experience study is about.
And that's due, when did you say?
That's going to be undertaken in fiscal year 2024 with our actuary. But the actuary will come to the pension committee first and discuss how the experience study will be conducted. So you'll have an opportunity to talk to the actuary and ask questions of the actuary in fiscal year 2024.
Yeah, they conducted one in 2019 already.
Yeah. I have one question. Moby?
What is that study trying to, can you elaborate on that study?
They're attempting to measure the liabilities as accurately as possible by looking at assumptions for things like retirement or separating, withdrawing contributions. So it's done to better estimate liabilities. That's what an experience study is done.
Because
the purpose of it.
the changes which were proposed, some of those changes were in fact originally in our pension plan, and from my understanding, what actuarial manager came back, except for the third item, the first 2 items has positive impact. So why we cannot move on those 2 positive impact?
So I will just say for the record that this is an information item. This will be discussed in fiscal year 2024. Any questions we can send to our actuary, but right now, this is not on the agenda, so it's not properly before the committee to discuss, but you have the information. Why don't you all take an opportunity, because the opportunity needs to be taken by the committee members to actually review the information items, and we can bring this back up during our experience study with the actuary. We'll make sure we schedule something with the actuary to discuss with you all, so he can provide a more complete definition of what an experience study is. For the very first time in 2019, the pension committee actually conducted an experience study. We're on point with the best practices of pension committees. That's why we did an experience study. And that's why we passed a resolution to make sure that experience study is done on a 5-year basis. This is the first time that the board has ever actually done that. So,
Can I ask a question? So I know, Greg, you mentioned that there's going to be an overview of our usage, our liabilities. I guess it'll be an overview of the 2019 experience study in July or August.
The actuary is coming next month or in August to discuss the 2023 contribution report. So that's the annual actuarial presentation. It'll discuss all the funding status and the calculation of liabilities. That's right.
and then the actuary will take the 5 years prior to 2024 to conduct the 2024 or 2025 experience study. So you'll take all that information that he's gleaned from 2019 to current to do the experience study for 2020, starting in 2024.
And is that the appropriate forum to ask questions of maybe someone on our side who is over the pension?
Yes.
So they'll be there to answer those
Yes,
questions?
Marquette, our actuary, will be here. And so you'll be able to ask those questions of
Rudd and
Marquette.
Wisdom is the actuary.
I'm sorry, Rudd and Wisdom, yes.
Okay, I was
Okay,
thinking
sorry.
more like on our benefit side to understand some of the,
So you're speaking of
Yeah,
Stephanie?
Stephanie Chambliss be
Yes.
present, so.
So what you propose, what my understanding is that we gotta wait till 2024.
Correct.
Make a request.
Yes,
You want something reviewed or some?
yes.
Then making a request for a year.
So Marquette responded to your request, and that request now will be sent to the actuary again for the 2024 study.
Can't you request it on a month, for the next meeting? If it's just one item, I think I know we saw about, if it's just one item, can you
So-
ask him to review one item?
Yeah, he already did.
He did,
already
he did. And
he-
that's why I'm saying to the committee, take a look at the information items first. And then when Marquette, Rudd and Wisdom comes, the actuary, and he is conducting the experience study, you'll have an opportunity to ask questions and ask specifically and have a more robust discussion on what should go in an experience study. He can give that all to you. And we'll make
My
sure.
question is that if, please forgive my ignorance.
Mhm.
If something is settled by the actuarial manager from his comments on the proposed changes, why we have to wait for another study and another outcome where these are established benefits already dictated by his research? Only one item was left out, which they needed more study.
So I think what needs to happen at this point, because this is not properly before the committee to discuss, every committee member, including the Board of Trustees, should have an opportunity to see the information items and read the information items so we can discuss this more thoroughly and be educated. So right now, I would like the pension committee members to take the information that you have before you to have an opportunity to review it. And we'll invite Rudd and Wisdom, the actuary, back here. Or we can have meetings with the actuary so they can talk to the employee members to discuss actually what is an experience study and what should be included in an experience study. Okay?
Yeah, and the point is, just to reemphasize, we are looking at this matter, and we want to follow a process in terms of how we address it.
Yes.
So, I mean, just can you give me in a nutshell, if we all concur on something?
but that's not what happened here. This was a single request from a single person. This was not a concurrence of a
No,
request. I
Rebecca,
just wanna
what
be
I'm
clear,
asking
though.
is that, taking into account if we all concur, when can we have these item on vote?
When the experience study is conducted, I think first and foremost, it's not fair for the employee members or the Board of Trustees to not have an opportunity to look at the information item first. That needs to be reviewed first, and so that people can have questions and determine whether or not they want it before they want to go forward with the pension experience study. So right now, we have to move on. As I said before, we have this before as an information item. And so the chair will make that determination as to how we move forward. But pension committee members, as well as Board of Trustees, should have an opportunity to review the information items so that they can have an opportunity to determine how they would like to move forward as well. Okay?
Correct.
So
Okay.
when we are meeting with this manager, can we set a date?
We will talk to the chair, and the chair will be in touch.
Yeah,
Okay.
I will.
Okay?
I mean,
I
we
will.
cannot wait 3 or 6 months for something like this.
So do we have any public comments? No public
No
comments?
public comment.
And so I think, Chair, we are ready to adjourn.
Okay. If there are no other matters, no public comment, I'll entertain a motion to adjourn.
So
We have a motion and a second. All in favor?
Aye.
Motion carries. Thank you
Thank
so
you,
much.
sir.
Thank you,
Thank you.
Quaco.
Thank you.
So,
The time's of flight.
Great.
Plenty of time.
Thank you, John.
Don't forget to have Chris give me a call today.
so employee
if you can.
members, I need you all to look
Yeah,
at the
okay.
information. You said you didn't get it?